John Higgins, Mortgage One. Happy Monday. Not too much information as far as interest rates go over the past week, but we've got the debt ceiling issue that is putting some pressure on interest rates. If you've been following along, obviously the federal government is fighting again about raising the debt ceiling, and that because it calls into question the sanctity of the US dollar as the world's fiat currency, and defaulting on all of our interest payments that are coming due is never a good thing for interest rates and our economy. Like these things have done in the past, they usually go to the last hour and get worked out. But this time, because Congress is somewhat evenly divided in the House, it only takes a few House members to really put the debt ceiling question to test here. And there's still some nervousness that they won't get this figured out, and that could be very, very bad for interest rates. So, of course, we'll have to watch that. In addition, if you've been watching what's been going on with the regional banking issue that we've seen, so we had 4 very large banks fail this year already, and that kind of has potted down here a bit. Some of the other banks that were on the watch list for bad things happening, their deposits are up, and the health of that regional bank system seems to be a little bit better. So bad news is good news as far as interest rates go, and so good news on the regional bank side has put a little pressure on our rates as well. And then factor in all of the Fed speech by various governors from the federal bank, and they are talking tough right now. So we've gone from, after the last 25 basis point increase, the market was pricing in about 2% chance that we'd have an interest rate rise in the next meeting. Now it's up to almost 30%. So you're starting to see the economy roll along. Right? We've talked about the jobs numbers that have been very, very good. And that's great for the real estate industry because obviously we need people with jobs to buy homes. But that also puts a little pressure on interest rates. So we'll have to watch these little cross currents here going forward. Inflation is still the number one enemy of interest rates, and that's why the Fed is talking tough. And right now, interest rates are a bit more stubborn, I think, than the market had hoped. But we'll see as the new data rolls in for CPI and PPI this month, and we'll see what that bears for interest rates. So have a great day, and we'll check in with you next week.